But as Hugh mentioned, if you don't want to spend $1,850 for that 4-year-old cow and you want to operate at lower stocking rates, is there anything that you can do to utilize that enormous amount of forage that we've experienced this spring? And I know a month ago or so, I told my wife Juanita, I said, you need to look around this spring, because in the 35 years we've lived on our place, that never has there been as much feed growing as there were this spring. And I can't explain it, but I'll just accept it and realize that it's about as good now as it was bad last summer, and we can be thankful for that. So as we ponder things we can do to utilize this forage with less number of animals, what can we do? And I think there's some things that's already been mentioned today, and I'll try to just maybe expound a little bit on those. We're going to break our talk into really two things here. One is to talk about some options, and they won't be complete list. They'll be selected options that may be the most obvious for us to think about during the lower stocking rates. And then we're going to look at retained ownership, if that might be something that you'd want to consider. The four things we'll look at here in terms of managing at lower stocking rates: of course, you've got excess forage. You don't have as many cows this year as you had last year. And so one way would be to lease out that excess forage. We might talk about what that might be worth in today's environment. A stocker enterprise. Some of you may have skill sets, infrastructure to support a stocker enterprise. That might be another way that you can sell your forage, because I think what most of us are as landowners is we're forage producers. You know, we think, well, we sell beef, and we do, but that's how we market our forage, is through cattle. So basically we are forage producers, and so how best can we market the forage we produce at a profit? One way is through a stocker enterprise. A couple of ways to do that. You can buy your own stockers, or you can take stockers in on gain. You know, it's getting kind of late in the spring and early summer here to find someone that would be willing to do that, but you might. But that could be an option for you. And something Dr. Gill mentioned earlier, and we really didn't converse before today about this, but I thought it was interesting that he mentioned this about calving in the first third of the calving season. What does that do to forage utilization? We'll try to find that out here and answer that question. Something else Dr. Gill mentioned is what about a terminal sire with good genetics? Does that in itself, how is that going to impact forage utilization? Does that require more forage? And I think it might. So these are four things we're going to look at that might help you sell more of your forage that you've produced this year without actually increasing cow numbers. If you're going to lease your land and not utilize some of these other options, I recommend you do that on a per animal or per head rather than on a per acre, because when you buy a sack of feed, you buy it by what's in the sack of feed. It's usually 50 pounds. You know what that is. You know what the nutrient value. It's got a tag on it. So when you lease out your land, you want to lease what feed or forage you have for sale. So these are numbers I would say are ballpark, and you can negotiate higher or lower. But I'd say this is a number that you might think about as an animal unit year, what you could rent your grass to someone to put a cow on your place for a year long, $200 a head. If you're going to do it by the month, and I had a conversation just yesterday with a gentleman that had a neighbor that wanted to put some, he had excess forage, and he wanted to put some cows on him, but only for 3 months. And I said, well, you know, you're going to produce roughly 75%. I think that's the number Chuck uses at times, about between now and July. 75% of your forage is going to be produced during this time. So you need to get, I would say, close to 75% of that $200 in the next 2 months. So that may not be $20 per month per head. It may be $30 or more than that. So kind of depends on your situation. But I'd say here's you a couple of numbers that you can work with and go from there if this is an option that you're considering. The other thing would be look at a stocker enterprise where you purchase the animal. Anybody willing to raise their hand and buy some of those high dollar calves that's being sold right now? Here's what one, a market report from this week, what it looked like. 550-pound steer in Oklahoma City brought $1.88. We're going to make some of those risky and difficult assumptions that Stan talked about earlier, and those are the lists that we come up with. Death, loss, interest, vet medicine, receiving feed, your numbers may be different, protein for 90 days, fly control, labor. One thing that's not in there is pasture. You know, if you was going to put pasture cost in there, and it would probably require about 100 pounds of fertilizer, which would cost you about probably $80, $85 per animal, and so it gets much higher than that. But again, we're assuming we have excess forage, and here's a way that you can sell that forage is through buying a stocker calf. So the profitability might look like this. If it gained 270 pounds during this time period to October the 15th, from April the 15th, your break-even price is $1.46. This gentleman out here talked about what's happening to the futures market. Well, it's been pretty volatile, hasn't it? We've seen about a $13 adjustment downward, and then just in the last 3 days, we've seen about a $5 adjustment upward in it, so quite volatile. I did this bottom part a couple of days ago, and that value of gain was about 69 cents. Your cost was 60, so there wasn't a lot of margin there, as Stan talked about in this feedlot versus a cow-calf business. You know, being a margin operator would be a stocker operator here. But when the feeder cattle futures closed up the limit on Thursday, I thought, well, I might ought to look at this again. And so based on October feeder cattle contract on Thursday evening closed at $1.5740. So it's only about half down what it was. That changed that value gain to 78 cents. So we can clip about a $50 a head profit if we assume these costs here by purchasing this stocker animal. And again, this is a way to sell some more of your forage. 60-cent cost of gain, 78-cent value of gain. And as you evaluate options, you know, Stan mentioned about, well, what's it cost to keep a cow? You know, in a stocker operation, we need to know, well, what does it cost us to put a pound of gain on a calf? And this, again, is assumptions that we made for purposes today. If we look at stockers on gain, there's a couple of ways we can do that. One is if you include care yourself, if you're going to take care of them when you bring them in. Kind of the market that I've been hearing on that is about 50, 60 cents per pound of gain, or if your scales are not close by, you could do that maybe 75 to 90 cents per head per day. So if you looked at 100 days there, that'd be about $80 a head. We don't have the risk of ownership Of course, if the price goes up, you don't have the option to make more profit either. So, in economics, in the economic world, we kind of say there's a basic assumption that risk and profit's directly related. The higher the profit potential, generally the higher the risk. So in this case, there's not a lot of risk, especially if you did it on a per head per day. Of course, if you went a longer season to 180 days, well, then we've got $144 there if you've got enough forage to sell that away. Some people don't want to be involved in taking care of those, so we're going to lease the grass only and not provide any care. That market value is a little bit lower, 10 or 12 cents per pound of gain less, or 15, 20 cents a day less than when you provide care. So 100 days is $65, so we're getting pretty close to down what our profit would be in purchasing an animal and running it, or for 180 days it'd be 117. So that would be something you can go by and putting your numbers in here and see whether you want to sell some of your grass through a stocker enterprise, either by owning stockers or taking cattle in on the gain. If we talk about calving in the first third of the calving season, again, we're going to make some assumptions. The calves are going to be 60 days older. If we assume a 90-day calving season, calving the first 30 days, Dr. Gill said that they're going to gain about 2 pounds a day. Glad we agreed on that, Don. Calves are on average going to be 120 pounds heavier. And so you run those through and how much more forage that animal is going to eat. That's about 18% more forage just by having your calves 60 days early. 18% more forage that you'll sell through your calf crop, calving earlier rather than later. I mean, this is something that you can do just with your management. Doesn't require paying $1,850 for a cow. This is one you already own, and you can just sell 18% more of your forage with a 60-day older calf. If we look at the other option of using a terminal sire with good genetics, and Dr. Gill stressed good this morning, I think, on her genetics, does that require any more forage? We're going to make some assumptions there. High growth terminal sire, unrelated breed to your cows, and we're going to increase weaning rates. Now, I didn't hear Dr. Gill put a number on this, so I'm going to put it on there, Ron, and call it 75 pounds. So if we weaned a 75-pound heavier calf, how much forage does that take? And I think if any of you have changed from like a straight bred operation to a crossbred operation, the calves are bigger and it does take more forage. So with that, it takes 8% more forage if you just use a breed of a sire of a different breed with good genetics. So there's 18, 8, 26, over 1/4 more of your forage without buying any more cows. You can sell 26% more of your forage through your calf crop just by doing these two management things here. So one of the things that you can think about there as you go forward in the future, and that is all dependent on the management decisions that you choose to make here. We're going to switch gears a little bit and talk about retained ownership, and simply what that means is just owning your calves beyond weaning. How long is that? Of course, there's a lot of different programs and strategies to do that. But one of the reasons that we consider retained ownership is that over 70% of the cows in this country calve when? In the spring of the year. And so if they calve in the spring of the year, they normally wean in the fall of the year, don't they? If you look at this graph up here of 500 to 600 pound steer calves in Oklahoma City, when is the lowest price of the year? In October, and that's by no coincidence. That's when most of the calves come to town. So in retained ownership, we would try to move our selling point from the lowest point of the year, at least in the I would say in the most modest attempt to retain ownership, minimum of 45 to 60 days, we could move that over to a little bit higher time period. And of course, if you can see the one line that goes really up is in 2010. 2011 prices are not on here, but if you put those on there, 2011, it would be very similar to the 2010 prices, meaning that price increase from October to December is going to be much more abrupt and upward sloping to the right as a result of those 2 years of price that we encountered late in the year. And so if we can move our marketing period from the low period just a couple of months, I mean, that in itself could help us some. Okay, so when we consider retained ownership, there's some things, a little bit of homework we need to do, and we'll move through these pretty fast here, but you need to know your production cost. What's it going to cost you to put a pound of gain on that calf that you keep a little bit longer? You need to evaluate your resources, your infrastructure. It takes a little bit more items, more corrals, more water points, a lot of things to handle calves than it does a cow-calf operation. I can recall one time talking about retained ownership with someone. They got a little bit cart before the horse, and they did keep their calves, and they didn't have quite the infrastructure developed for them, the water points, and they really got into a very bad situation. And so you need to have some things in place if you consider retained ownership. Not only your facilities, good fresh water. I know there's been several times in our talks today we alluded to nutrition being key in a lot of different parts of our cow-calf production systems. And water is one of those nutrients. And so high quality water can make a lot of difference in how much gain you get each day. Feed handling and troughs, you're going to have to feed them some. Small grass traps or pastures. The forage availability and quality, it takes a little bit different kind of forage to make a calf gain than it does to maintain a cow. The health program, we've alluded to that several times today. Numbers and uniformity, as Dr. Gill mentioned, it's going to continue to increase. Ununiformity will, instead of gaining uniformity. So if you've got a pretty diverse calf crop, retained ownership is probably not going to help that much. Financing, it can disrupt your cash flow. We're gonna not sell them for 60 days or maybe 120 or 150 days later. Tax implications. Are you going to have 2 calf crops in 1 year? That's something to think about. Risk management. Something we hadn't talked a lot about today, but probably one of the keys to successful producers today and going forward is going to be their ability to manage price and market risk because of the volatility that we've seen. Just what happened to something that was almost completely outside our industry when we talked about this pink slime issue and what it did to our markets. BSE in 2003. These are things that can really cause huge volatility in our markets. So if you get past these things and still want to consider retained ownership, the types of those are, just precondition them at minimum for 45 to 60 days. Dry lot or grass with supplement. Ball out and go to small grain pasture. Ball out, dry winter, then grass next summer. These are just, again, selected options for retained ownership. Cattlefax, located out in Denver, Colorado, has spent a lot of resources analyzing different retained ownership programs. And the one here about ball out and go to small grain pasture is probably, according to their analysis, has creates the most advantage over weaning, selling at weaning, of any of these here. If you have that opportunity to have wheat pasture, that's a very good option, I would say. Kind of looking at an example budget just on the dry lot, what's it cost? And again, these are just making some assumptions, and this would happen next fall of 2012. Your vaccination, dewormer, death loss, 0.5%, treatment, feed, $200 a ton. What's hay going to be worth? $100 a ton, half what it was last year. Fly control, labor. So if you put 100 pounds on them, your cost of gain is going to be 91 cents. So what's the value of gain going to be? We don't know that today, but I would say that when it comes time for you to make this decision, you have to determine what that value of gain is. And that's a pretty simple concept, but it's misunderstood by a lot of us, and we're going to go through an example of that before we quit here shortly. But that's a dry lot. It's quite expensive, as you can see. What if we went to a forage base, and maybe we can sell some more of our forage here? Again, we don't have the feed as much, only 10 days in the dry lot while we're getting the ball out. $46 a head is what we're going to spend on them. Our gain's not going to be quite as much, so it goes down from 91 cents to 61 cents. But is it still profitable? We don't know what the market's going to pay us for that pound of gain that we put on. So we've got to determine what the value of gain is. We've looked at cost of production. What's our cost of gain? You've got to know what that is. Oftentimes we know how much we're spending each day feeding this animal, what it's costing, but sometimes we don't know what that animal's gaining. So we got to have those two pieces of information in order to know what our cost of gain is. And then value of gain, what is that? So if we precondition those 60 days and utilize our forage, it requires 13% more forage to do that. And so now, here's three things that we can do to sell more of our forage through cattle without buying one more cow. And we're up almost to 40% of our forage base with these three practices. So we're going to go real quick through some how to value gain. We need a market report. We need to calculate what that calf is, dollars gross per head, between the two different weight ranges you're looking at, and then divide by the difference. So here's a market report. This is the market report for Oklahoma City, Monday of this week. You can look there at the top, 284-pound calf brought $246 a hundredweight. Middle of the chart there, a 729-pound calf brought $1.49.83. And this market report you can get newspaper, you can get it mailed to you likely, you can get it on the internet. This is the first piece of information that you have to have. So we look at that 84-pound animal, and he was worth almost $700, $698.64. If we went one increment to 330 pounds at $2.31 a pound, or $231.94 per hundredweight, gross value of $765. So those are the first two things you have to do, is to figure out what their gross value is for each interval you're looking at. The difference in weight's 46 pounds. The difference in gross value is $66. So the value of gain is $145 per 100 pounds, $1.45. Can you put a pound of gain on that calf for less than $1.45? if you can, you're making money doing that. Look at some other weights here. Go from $729 to $774, $1,092 to $1,131. Got to figure out what those two gross dollars are per head. The difference is 45 pounds in weight and $39.10 in value, so it gives us an $87 per hundredweight value of gain. So you compare your cost of production versus what the market's paying you for it. Maybe retained ownership is for you. If you looked at the whole market report, went from 284 pounds to 963 pounds, that 679 pounds difference is worth about 80 cents a pound. So if you look at the market report for this week, on the right-hand side, here's what the value of gain is for each incremental weight range. Pretty high values right up in here, isn't it? $1.45, $1.14, $2.05, going from a 436-pound calf to a 486-pound calf. This week, the market paid over $2 a pound for that weight gain. You get down here, and here's from 573 to 623. The market paid a nickel per pound. Can you put weight on for a nickel? Likely not, unless you have zero opportunity cost for your forage. So if you were looking at buying a calf, you would look at the weights that you would buy a calf where you can put it on cheaper than what you can buy it at. So here, if you could manage and keep alive a 284-pound calf and put it on less than $1.45, this would be the weight you'd be wanting to buy it. If you were looking at selling, you would want to sell, put weight on as long as the market's giving you more than it's costing you. Maybe right here at 573, you went to 623. The market's not paying you very much, 37 cents, 29 cents, not until we get down here. If now you had a 729-pound animal, should I keep it to put 100 pounds on, go to 888? Well, that value's up here in the 80 cent category, so if you can do it for 60 cents, then you might want to consider that. And sometimes we don't have very high opportunity cost for our forage, and so sometimes selling this forage through animals is if we don't have another option for it, opportunity cost is pretty low. So we may want to keep those animals a little bit longer and sell some more forage through them. So two things we need there is cost of gain and value of gain. Compare them, and as long as the market's paying you more for your gain than what it's costing you, then it's probably a good deal to do that. So just kind of some parting thoughts you might say here is that we can utilize almost 40% more forage just utilizing these three practices, and it's not going to cost us really a whole lot more money, and hopefully it'll be money in our pocket. So just real quickly, I'm going to add about another 6 or 7 slides here. You've seen some of them, but I do want to leave you kind of with maybe on a positive note here about the future. Here's what happened last year in 2011 to cattle numbers. In Oklahoma, we went down 288,000 head. In Texas, a minus 660,000 head. So the United States lost almost 1 million head of cows. Stan mentioned earlier about what's happened to our cow population. It's the lowest today than it's been since the 1950s. In the last 60 years, it's lower. Likely that 2013 number is still going to be less again than it was this year. That's a ship that don't get turned very quick. It takes a while to build cow numbers. It's not like setting some eggs and you get chickens 21 days later or so. It takes a while to turn that around. So it's not gonna change real quick. We're probably gonna see January 1, 2013 cattle numbers even lower than they were this year. Stan mentioned about the feeder cattle supplies, lowest in a long time. So we're going to see pretty high calf prices as a result of supply and demand here. Exports, Miss Heather at noon talked about how strong exports have been. Here was where they were in 2003 prior to the BSE in 2004, and we've gradually made our way back to where the last 3 years they've exceeded 2003 numbers, and so exceedingly strong export demand for U.S. beef. It's resulted in record high prices for 500 to 600 pound animals. Here's what it was in 11, 5-year average. We're way up here, much higher than we ever thought we would be. 700 to 800 pound cattle, up to $1.60. Amazing. I think all of us have received some sticker shock when we've hauled calves to the sale and seen our check come back and how much it's been. So very strong. Corn crop. Dr. Gill mentioned that just the income's not all we have to look at. We got to look at cost. And so here we're looking at the largest corn crop ever produced. If it materializes over 14 billion bushels, we should see price retreat somewhat down. I'm hearing more and more grain analysts talk about having corn this fall with a 4 in front of it, and I've even heard some mention is with a 3 in front of it. So if Mother Nature cooperates, we'll see lower feed cost for our calves this year. Cow-calf returns, here we are in 11 and 12 compared to years gone by. I mean, exceptional. Stan showed this chart here about FAPRI, one of the sources of long-term cattle prices. And if you look here at feeder steers, 7 to 8 weights, going up through 2013, leveling off 14. But still, staying in the $1.40 to $1.60 range. Fed animals for the to 2021 above $1.20 to $1.30. Strong prices. It doesn't go without saying that we're still going to have to manage our cost with fertilizer prices, fuel prices. I mean, it's still not an easy come, but I tell you, it's pretty good times. And so I would say to you that, enjoy them, go forth, and do good, and enjoy the times. And seen this quote by Alexander Hamilton. It says, any genius I may have is just the fruit of thought and labor. And so, you have control of that. And so I would encourage you to think about some of these things and trying to sell more of your forage through the cattle numbers that you currently have. And I know it's been mentioned today several times, but you can retrieve these presentations at this website. So if you don't have it already, well, here's you another opportunity to write that down. And again, thank you so much.